Understand economic growth and GDP. You guys might have heard these terms again and again, and many of students are not familiar, or those who are starting out in economics program. It's just basic things I would like to go over. So, what do we understand by economic growth? Well, in simple terms, uh, an economy's ability to produce greater levels of outputs. Okay, so when we say outputs, it means that the economy's total goods and services, what it produces in a given time, maybe for a 1 year, 2 year. So that ability to produce the greater levels of output is usually known as economic growth. So if, and say for example, if some country's economy or their total output is not increasing, then we say, okay, there is an economic slowdown in those countries or economies. But in those countries where there is a steady growth, it means that the total output of, of that country is growing, or economy is at a steady rate growing. So what is a common term which is used to measure the economic growth? Uh, Typically, or in economists, they prefer to use GDP, percentage change in nation's GDP, as a measurement to measure economic growth. And what is GDP? GDP simply stands out gross domestic product. That means how much is the dollar value of the total goods and services produced in a given time. Okay, there are two ways to measure the GDP. One is expenditure based approach, another one is income based approach. Both approaches to measure GDP, they have its own advantages, disadvantages. But in simple sense, the expenditure based approach tries to uh, tries to get the total of spending on producing final goods and services. So let's say you spend X dollars, okay, on creating or on delivering the services, or what is the total expenditure, okay, in a given time. So that total expenditure would become a measurement of GDP, and you can calculate the total dollar value. Okay. Well, these terms, these GDPs are calculated by different countries' national standards by economists. But nevertheless, having a rough idea what these terms means are helpful. Income-based approach, on the other side, uh, they try to get sense of the how much total income is being generated or earned by producing final goods and services. Okay, now let's talk about how we can formalize GDP based on expenditure and income. Okay, so if we talk about GDP in terms of expenditure, we can put a formula to it. We can say, okay, how much is the consumption? C is the consumption. So how much is the consumption? Okay, how much is the government spending in a given time? How much is the investment made in a given time? And how much is the net export in a given time? So X minus M is the net export, where X is simply the export amount and M is simply the import amount. So that simple formula to understand how GDP can be calculated based on expenditure approach. C plus I plus G plus X minus M. Simple. Okay. So you add up all the consumption, investment, government spending, and how much was the export minus how much is the import to the economy. Okay. Now, if we talk about the income-based approach, so how the formula would look like. Very simple. Wage plus rent plus interest income plus profits plus foreigners' income. Now here the term profits simply accumulates all sorts of tax benefits, other sorts of income, so you may call it a cash flow. But idea is simple, that to add all the income. Good. Now let's talk about business cycle in relation with economic growth. Okay. The economic fluctuations in total output and how these are going to affect the employment rate in a given country, given economy. These are typically known as business cycles. Business cycles are nothing but the economic fluctuations. And the common ways to see these cycles, if we try to plot GDP over time, then we can see these cycles. And economists term these as these cycles, business cycle, or cycles in a these are cyclic behavior they have observed. So how does it look like? It looks like something like that: going up, then going down, then going up, then going down, then going up, going down. So this kind of a up down loop keeps on going. Okay. Now let's try to analyze what information can we extract from this behavior of GDP over time. Okay, so let's talk about, let's say if we try to do some mathematics or some fancy things with this graph. Let's draw some lines, and we draw some line touching the bottom. We draw a line. Okay, then the peak, we draw a line, and we find an interesting behavior that wherever the line is crossing the next phase, okay, where the curve is going upwards. Let's put a point here. So as you can see, we have 3 intersections here. And if we try to understand, we can understand different terms. So let's take a small portion of this curve, and we can see that there is a peak. Okay, there is a trough, and we can put a label or name of certain portions of this graph, say from trough to this green point where the horizontal line intersects the curve. Let's say recovery, expansion, contraction. So these are different terms comes in literature, or you might be preparing for CFA or other exam. It's a good idea to have an idea about these terms. Okay. So we say economy is going through true phase when GDP is at the bottom. Okay. Yeah. So GDP is at the bottom. We say, okay, economy is going through true phase. Then after that, economy is recovering, and where we hit the horizontal line with the curve, after that point we say economy is expanding, and at the peak of this curve means economy has reached at its peak, and now it looks like that economy will contract. Okay, so economy enters in a contraction phase. So this whole cycle keeps on going. We can put labels at different other parts of this curve, and as you can see, we observe this behavior of cyclic behavior in GDP over time, and that cyclic behavior is known as business cycle. Okay, Now let's try to understand a little more insight of these terms and how the GDP is behaving and what information we can extract. So let's understand first the expansion phase. So in the expansion phase, we are here. So when the economy is expanding, inflation is stable. Companies, they see a rise in the profits. Stock market activity is strong. You would hear the news that, okay, stock market is booming, blah, 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 it's a bull market, whatnot, different terms. But in general, investors have confidence in the economy and they are buying assets. And when investors are putting more money into the companies, public companies, automatically the share price goes up. Strong stock market activities. And unemployment rate is steady. Okay, it's not going up, not going down, kind of a steady unemployment rate. People are getting hired, getting fired, but steady unemployment rate. They are able to get job. They get fired. So that's the expansion phase, that now economy is expanding. Remember the incident of 2008 US housing market crash? And then after that, economies went into the recovery phase and now expanding. So that's similar scenario. Okay. Now let's understand another term when the economy reaches at its peak. So what information do we observe in the economy? That simply demand overtakes the capacity. The economy is not able to produce the goods and services. However, their demand is more. So what's going to happen? It will lead to rise in inflation. Interest rates will rise. And if the interest rate rise, the automatic impact is in the falling bond prices. Sales will decline and all sorts of negative things will occur. The stock market activity, stock market will experience a slowdown. Prices are going down and whatnot, blah, 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 blah. Okay. So this is an interesting point at the peak. So let's say if somebody buys a stock at its peak when the price is too high, it's not a good idea, because now the prices are too high, but it's gonna go down. So it's a better idea to hold off and buy when economy is at the through phase. And if somebody buys here the stocks, they will make more money, more profits. So one needs to have some idea about business cycle fluctuations. Even though if somebody says that, okay, I'm just doing micro investments or I'm just focusing on microeconomy, hold on. Well, if macroeconomic principle says something else, the overall profits will suffer. So it's a good idea to take into account both macroeconomic and then do microeconomic analysis for investing in different economies, different markets. All right. Let's try to understand another term called contraction. So as you can see here, in the contraction phase, the GDP starts to decrease in GDP. What it means that the production will decline, there will be layoffs, and more people will be in the job market looking for jobs. So unemployment rate will be high. People will spend less and they will save more, and that leads to when companies are laying off people, companies are cutting the cost cutting, whatnot, overall family income would decline. And economists conclude that, okay, now we are getting into recession phase. Okay. Now let's try to understand through phase. Remember, we talked about through phase. It's a very interesting phase here. But it's difficult to predict what's going to be, what is the through phase. Okay. Since the interest rates are falling, okay, it starts falling at the peak and then keep on falling in contraction phase, they are falling. That triggers a bond rally. But now it's at the very bottom, and people, or in general investment managers, they think, okay, it's a good time to buy bonds now. So bond rally starts. Okay. And inflation falls. It's here in contraction phase, and peak phase, economy experience high inflation. At through phase, very low inflation falls. Very low inflation, it keeps on falling, falls actually, it becomes a stable sort of thing at a very low point. And people start borrowing more money. They start, okay, let me get the mortgage. Okay, let me get the loan. Let me start developing my business, take the loan from the bank. So see, overall business activities, they start blossoming, they start moving forward. And as things happen, stock prices are at the very bottom, and now the stock price rally or stock market rally also get triggered at through point. Good. Now understand the recovery. So at the recovery, as the name suggests, economy is recovering. Okay, economy is recovering. Layoff period is over, and companies are not laying off anymore, but they are pretty cautious in hiring. They will do hiring, but very cautious, very conservative hiring, and it's still not very much significant investment. But as soon as the GDP crosses this point, and enters in expansion phase, boom, companies starts to hire again, starts to invest in new projects, and all sorts of growth activities starts going on when economy enters in expansion phase. But the trigger point is roughly this green point on the curve. All right, so these are some basic terms what we learned in this lecture. Thank you very much for watching LeProf lectures on YouTube. Please do subscribe, like. We appreciate your feedback and support.